So today we're going to look at why everyone is buying short-term bonds or money market funds. And then I saw last night that Bank of America had put out a report saying that oil's off to $100. Is this right? Then the trading takeout today is ironically going to be on why we shouldn't really listen to the banks. So everyone is piling into short-term government bonds. I mean, why? Well, let's have a little look here. I want to show you this tweet. So the US money market fund assets saw the 12th straight week of inflows, increasing assets under management by 22.38 billion. Half the amount added last week to 5.598 trillion in the week ended September 12th, iMoneyNet says. So what does this mean? Well, a money market fund invests cash into shorter term government bonds. So from 1 month all the way up to about 1 year. And you can see here from the chart that the yield on the 1 year treasury is 5.445% roughly, which basically is high. And it's showing that the Fed are looking to keep interest rates higher for longer. So that's basically what this bet is. And you can see from the extent to which flows have occurred over the last 3 months, the last 12 weeks, people are betting on that same outcome. So this is effectively what the market is showing us right now. What does that mean? Well, for treasuries and for equities, they tend to work in opposites. So yields up, equities down. And it seems like that is going to be the continued view for a while. At the November meeting, I'm very, very focused on what the Fed is going to do, whether they're going to raise by 25 basis points or keep on hold, like with the September meeting. For me, I feel like one kind of erroneous data point could shift that quite a lot. But from the perspective of people that are buying bonds, they can lock this rate in now, which is why it's so attractive and why we're seeing such strong flows. For equities, it's a little bit different. It's there's less fixed income. I mean, we're looking at a fixed income product here with bonds. So that's why it's so attractive to investors who might feel a little bit scared at the moment. I've actually moved a lot of my cash into the Vanguard UK money market fund because it pays out about 4.85%, I think, and then there's a fee on top of that. So that's why it's not quite the 5%. But if you can go shorter dated, then it does pay out a little bit more. It's just it takes more rejigging basically. But on the 1 year works very, very well for me. So I guess I'm one of these people that are piling into shorter dated bonds, and it makes sense for me. I don't necessarily believe that the equity market rally is going to be sustained, and that's across different geos there. I don't necessarily think it's going to be sustained in the shorter run in the US. So I like to have the cash parked, in locally sourced. Locally sourced meat, if you like, which is the UK gilt market. And yeah, I think that's just what other people are kind of thinking about now as well. They're thinking that, the higher for longer narrative is going to remain for a while. They're seeing inflationary pressures, which I think we're going to get onto in the next piece when we talk about oil as well. So it does make sense. The one big risk here is that something unwinds the position and there's duration risk, which you don't really get on a 1 year perspective, or a sub 1 year perspective. Over 1 year, you do get that. So you could see some people kind of get ironed out, but not so much on the money market fund basis, more on if you're actually taking directional bet on bonds. So we want to press on to the oil story, which has been brewing over the last couple of weeks with OPEC cutting supply and also Russia jumping in. But Bank of America yesterday released a report, and I'm only showing an excerpt here because you can't show the full version, unfortunately. But they said that oil could spike past $100 per barrel if OPEC Plus keeps cuts. Now, that last bit is really, really key here, actually, if OPEC keeps cuts, because there's a likelihood that they might. But I want to continue here. With OPEC Plus in the driver's seat and Asian energy demand on the mend, Indian refiners have benefited from Russia and Iran sanctions by accepting lower cost crude supplies and exporting expensive products to Europe, which isn't good for European inflation and fighting the ECB. Going to come on to those two bits in a sec. But effectively, what we're looking at here is how price has rallied over the last couple of weeks because of these cuts. We saw in August, towards the end of August, I think it was the last week of August, that Russia had joined the Saudi cuts and the general OPEC cuts, while the US was depleting their oil reserves, leading to excess supply in the US, which has probably staved off the price increase a little bit. But something comes to mind here called "Don't Fight the Fed," which is quite ironic because something that we're looking at here is Saudi and OPEC actually fighting the Fed. That's what an OPEC supply cut is doing. So the question that we have to ask is $100 really in range? My view is it's not. Okay. The first reason is because the US demand is actually depleting. We saw that from or we can see that from what's known as backwardation occurring in the oil market, in the crude oil futures market, which means that the futures price looking outwards, sorry, just having a look at my mic there, making sure it's all okay, is actually showing that the price of oil in the future out to 2024 and beyond is decreasing. So prices are lower. Contango would show that prices are higher. So what that means is that the spot price, so the current price of oil, is high because of a cut in supply. It's not high because there's excess demand out there, which is why that if OPEC plus keeps cuts part is key, because that is kind of showing that they might actually be quite nimble with regards to increasing the supply again if the demand isn't there. But I think that the demand side is going to actually take over because what they'll find is that there'll be lesser demand and they won't make as much money up at this price at 89 plus bucks if they keep the supply where it is. They might have to increase the supply to reduce the price. So that's the way that I'm looking at this. And I think that over the next couple of weeks, we're actually going to see the price of oil reduce. We are above the 200 daily moving average here, though, which is key. However, yeah, it's quite an important number, that $100 level. And yeah, the don't fight the Fed part comes into play because, effectively higher interest rates are leading to lower demand while they're actually fighting the Fed by cutting supply. So we'll see what happens. But my view is that this could be a turning point, especially if we look at this horizontal ray here, where I actually think this is much more likely of a target initially. It's about $94. And then people tend to want to buy that for 100 and the market turns and we head back to the 200 daily. So keep an eye out for that, and do keep an eye out for anything coming out of OPEC over the next couple of weeks. So today's trading takeout, ironically, is why you should not really listen to the banks. I get all the bank research every single day, but there's kind of a specific use case for it, and it's not to follow what they say. I think certain analysts are better than others, and there's definitely fantastic information you can glean from it. But you've also got to think of the provenance of where research comes from. So banks aren't buy side, they're what's known as sell side. The buy side is your hedge funds, your asset managers, that kind of thing. Whereas the sell side, they're basically brokers, if you like. So brokers don't necessarily put on the same risk or have the same intentions as a trader at a hedge fund, for example. Traders at hedge funds need to have an edge. So you have to ask yourself, okay, why would banks be putting out this research, if they're looking to actively make money from the market? Well, they're not. They're supplying information to their clients for their clients to decide what to do with that information. So there's certain analysts, as I said, that you should pay more attention to than others. I think Bank of America do a fantastic job with a research report called the Flow Show, which shows where, different assets are being bought, which ones are being bought more than others, and the reasons perhaps for those assets being bought. And also they have a great piece called the Fund Manager Survey. But there's certain pieces that tend to get a lot of attention, such as Goldman's 5 best trades for the coming year, which I think in 2019, they actually lost all those 5 trades within the first 2 or 3 weeks. So there's reasons as to why you should and shouldn't pay attention to them. And the more experienced you become and the more you read these things, these reports coming from the banks, the more you can deduce kind of what's important and what makes sense to you. But a lot of the time, because they are analysts and they're not actually putting on risk as well, they might actually indicate tops or bottoms of the market, short-term ones anyway. So it's good to pay attention to them. And especially the reports that end up getting onto the likes of CNBC or just more mainstream news. They're the ones really to pay attention to as contrarian indicators. There's one guy called Marko Kalanovic who is at JPM. And, God bless him, he's a fantastic analyst, but he's been so wrong on equities over the last couple of years, so wrong, that it kind of became a bit of a meme in FinTwit circles and in finance in general. But he knows his stuff. It's just I don't know if he's a trader. There's a big difference between a trader and an analyst. So yeah, I think always try and understand the provenance of where the sell side's coming from. And if you do ever pick up on, a trend of something being good or something being bad, because bad information is just as useful in trading as good information, then make use of it. Note it down. Try and build a picture of, where these inflection points are with these reports coming out.